Well, I want to go ahead and just welcome everyone to this installment of Legacy class on the basics of investing. We have a wonderful class set up for you today. My name is Teresa McDuffie. I am your Legacy Program Director, and I do want to thank you so much for joining us today and just taking the time to want to build your knowledge and the basics of investing. We do have a wonderful speaker for you today. His name is Jimmy A. Lewis. He's with Consolidated Planning Incorporated. Thank you so much for being with us here today, Jimmy.
Thank you. Thank you. Looking
Now,
forward to it.
before you're welcome. Now, before I do start or introduce Jimmy, I just want to let you know that you're welcome to ask any questions that you may have. You can add your questions in the chat and someone will ask your question for you. Or when the speaker pauses and asks if there are any questions, you can verbally ask the question yourself. So we want you to get all the questions that you have out there so you can build your knowledge in investing. So now I'm going to introduce our speaker. We have again for you, Jimmy A. Lewis. He is a financial representative with Consolidated Planning Incorporated. Over the past 7 years, he has focused his practice on helping small business owners in an array of industries. Jimmy helps optimize their finances to achieve financial balance. This is accomplished by following a philosophy that eliminates guesswork, challenge financial myths, and minimize risk as the only option for reward. Conventional financial wisdom has failed. It's time to stop thinking there are one-size-fits-all answers, and instead prioritize and focus on tailored solutions that make the most of what you have. After graduating high school, Jimmy enlisted in the Air Force, where he served 27 years of honorable service, retiring in 2012 from Joint Base Charleston. Jimmy and his wife, Becky, have been happily married for over 38 years. They have 2 children and 2 grandchildren. And when Jimmy is not actively helping his clients achieve their financial goals, he is usually spending time with his family, usually hunting or fishing. And just to let you know, his education, Jimmy does have a Bachelor of Science, Business Management from the University of Maryland University College. Thank you so much for being here with us, Jimmy.
Thank you. Welcome, everyone. All right. So before we get started, just a few notes or highlights I want to mention is that this presentation that we're going to go through today, I present quite often in front of various clients and prospects. So I didn't want to reinvent the wheel. So there's going to be some language in here that seems like I'm making a recommendation. I want to make it clear that during the presentation, there are no recommendations being given. But I will always, the only recommendation I would recommend to anyone when they're considering investing is working with someone like me that's been in the profession for some time that can educate you on the best ways to invest that's suitable to you specifically. I also encourage anyone to also just read more. Not necessarily, there's a lot of information you can get online, but it also can overwhelm you and you will find whatever you're looking for, I promise. You might found something that might make sense to you, and then you'll turn right around and find something that's contrary. So it's best to talk to someone who has been in the industry for quite some time, and also to academic research or books that rely on academic research, and then from there. And then the other thing I want to mention is that everything that I mentioned as far as numbers, now there'll be some real data in the presentation, but when I'm talking about hypotheticals, and that's what they are, it's just using a hypothetical rate of return, for example, is not, it's just for the discussion to reference, what a negative rate of return, positive rate of return, um, going forward. Everyone's situation is different, and everyone's investing experience is different, from never investing to being, investing on their own. So with that being said, I'm going to jump right in. Just like was mentioned before, if there's any questions, feel free to jump in there. I will pause from time to time and ask if anyone's got any questions. I'm going to assume silence is that we're good. And there's a lot of material, can be very technical. Again, I don't know what everyone's level of experience is. So if someone wanted to learn more or have me back up and explain something in more detail, I'm prepared to do that. All right, without further ado, I'll just jump right in here. And Park Avenue Securities, it was mentioned that I'm with Consolidated Planning. Consolidated Planning is what they call a general agency that supports me with the resources for me to run a financial planning practice, not only for business owners, but for families as well. And I work with all walks of life, if you will, all economic levels, all ages, different levels of experience. So I've helped people that are in their teens, clients that have teenagers that they just want to learn more as they're entering the workforce, maybe, or getting ready to graduate high school or college, and they just want to set them off on the right foot. I'm happy to sit down with them and give them a broad overview about different things about debt management, possibly school debt for college funding, compound interest, all those sorts of things, and just quite frankly, what a good saver looks like. And then I also work up and through retirement. A lot of people think of financial advisors as accumulating wealth, helping them, with investing over time. But I also work with clients in distribution planning, i.e., they've already retired. They're no longer working. So I'm helping them manage where they're pulling money from. There are different types of money that, when you're accumulating wealth, should be in different buckets, if you will, because different buckets have different tax implications. So in retirement, we don't want to, give the IRS more than their fair share. And when it comes to legacy planning, that's important as well. But I'm going to jump right in and get going. But the other side, I'm sorry, let me back up. Consolidated Planning provides the resources. So I'm appointed on the investment side or security side with Park Avenue Securities. So I want to eliminate any confusion there. Park Avenue Securities is who I use to help provide the investment options to all my clients. Now, what we're going to talk about today is why invest, what it means, the important investment principles when it comes to investing. We'll talk a little bit about average investment behavior and how that can be contrary to what you're trying to achieve, and how that can impact that. And then what it means to work with a trusted financial professional and next steps. So many of you may have heard of compound interest, but I like this chart here that kind of puts it in perspective. The earlier you start saving and where you save matters dramatically. For example, what you see here is the earlier you start investing, in order to accumulate $1 million by age 65, for example, someone at age 25, if they're earning enough to be able to save $381 a year, a month going forward, then, and never saved a penny more than that and invested it and earned a respectable rate of return of 7%, hypothetically, over that time frame, that 40 years, they could, quite frankly, easily achieve or accumulate $1 million of accumulated wealth. But however, if someone were to wait before starting to save and planning for retirement, and they waited till they were 35, now they would have to start saving on average $820 a month over that time frame, because they just lost 10 years of compound interest ability. Someone at 45, a lot of times I've got people coming in the door at between 45 and 55 usually, and they have some accumulated wealth, usually in their 401k. But why most people start to generally seek out someone like me at that time, which in my opinion is way too late, is that they're becoming empty nesters a lot of times. Their children have gotten to a certain age, they're getting ready to move out or have moved out recently. Maybe they have in college or have recently graduated and moved on. But at those ages too, that's usually when the most income is being earned. Most 45, 55-year-olds around there are at their peak earning potential. They're in jobs that's been there for, maybe been there a little while. They're getting paid probably more than they've ever been paid before annually. And there's a good likelihood as they get to close on towards retirement, they're not aspiring to go up the ladder and earn more money. They're looking more and more towards less stress and towards retirement, especially if feel like they're on track. In this case, age 65. Now, that doesn't mean someone couldn't retire sooner. Could mean that you need to work later. Most people that come to me, want to know if they're on track or if they're behind or ahead. And it all depends on what their financial picture looks like today. Not only how much they've saved, but where it's at, how it's invested, what are the tax implications going into retirement. So, and of course, you can see someone that if they've waited till 55 years old and they want to have earned $1 million in the next 10 years before retiring, they're going to have to save, $60,000, $70,000 a year or during that time on average to get there. So at a 7% rate of return in this case. And there are no guarantees. When you have that low time frame, earning a 7% rate of return in that average, you're kind of rolling the dice there based off of market history. So it just depends. I'll pause right now. I feel like I'm going 90 miles an hour, but has anybody got any questions before I move on? Okay. So why invest? So people don't realize this, but for the most part, but people are living longer and longer these days. You may have heard in the news where they're talking about Social Security and raising the age because Social Security, is not fully funded the way it should be or has been in the past. And a lot of that has to do with the people that are living longer. Today, baby boomers, people born between 1946 and 1964, that they are retiring or turning age 65 at about 10,000 baby boomers every day, and will continue to do so for the next few years. And what happens is that we have a workforce coming behind them that may not be able to fully fund based on their income and tax rates and so on and so forth to continue to fund Social Security for those baby boomers who are rolling into retirement and living longer in retirement than we ever have in past history. So what this chart demonstrates is that, just to give you an example, a male today going into, has the chance of 72% chance of living to be at least 80 years old. Now, if they were to retire at 65, that's 15 years in retirement that you would have to plan for. So if someone's used to living on $100,000 a year to maintain their lifestyle prior to retirement, and they go into just simple math, go into retirement, they would need $1.5 million spending at $100,000 a year if it was just sitting in cash, and they'd be out of money by age 80. So the more you save, the better off you are, and people need to continue to invest, not necessarily in risky investments, but earn a respectable rate of return, at least to keep up with the cost of goods. Because in that same 15 years, the cost of goods is likely going up as well. And I've never known a year where medical costs went down. But going back to the chart, 72% of men can expect to reach the age of 80. 80% of all women today can expect to live to be live to be 80. But the interesting fact is that if a married couple is married at age 65 and living, obviously, going forward, there's a 95% chance that one of the two is going to live to be age 80. Okay. On the right, to live to be age 90, a male can, 1 out of 3 can expect to live to be age 90. A female, 45% of all females can live to be 90. But if they're married at age 65, there's a 63% chance that one of the two is going to live to be age 90. Again, why is that important? That could possibly be 25 years in retirement. If you retired at 65, you need to have a robust and a strategic plan planned out to make sure that you don't outlive your money. And none of us want to live on Social Security alone. We don't even know how long that's going to last these days. But moving on. So we, and this is in general sense, what we normally do, or what I do, is I focus a lot on goals. That's the center of every financial plan or strategy that I build. So there's investing, and what we were talking there, I typically hear is retirement or retirement accounts. Where should I have my money? Should I have it, in a 401k? Should I be paying off debt? Should I be paying, have it in a Roth? Should I have it in X, Y, and Z? And I hear it all. And in all cases, it depends. It depends on what your goals are, what you've done to this point. Going back to goals are your short-term, mid-term, long-term goals, and income, debt, all that's taken into consideration. So, if you've never been able to enjoy, a great vacation every year, and your goal is that once you go into retirement is to go on a great vacation or a cruise every year, then we need to plan for that, because we haven't been doing that in our working years. We need to make sure that if that's your goal going into retirement, that we can afford to do that going in there. So we need to know those goals so we can plan for them. We also need to know, as we're going through that, is there any inheritance that's expected? What's your tolerance for risk? What's your longevity risk? I usually measure that by telling me about your parents. Are they still living? Did they pass away early? What did they pass away from? Is there a history there? And the other thing I talk about is sequence of returns. Think about, I'm not sure what the age is on this call or this meeting today, but it's surprising to me, how time flies. But 15 years ago was the Great Recession, the great banking and housing financial crisis, where a lot of people saw their portfolios drop anywhere from 50 to 60%. So imagine when I talk about sequence of returns of going to sleep in 2007 and everything's going well, and you wake up in 2008 in retirement. In 2008, half of your portfolio was gone, or the value of your portfolio has been depleted 50%. You've saved $1 million, now it's worth 500,000. Many of those folks at that time, that was reality, and they had to decide: is now the time to retire, or do I continue working to replenish the value of my assets? And we'll talk more about that on how that was demoed. But many had to delay the retirement for another 5 years just to get back to even. So that's what I mean by sequence of returns. Investment risk is, how are you invested? Very risky, moderate, or very conservative, and all have implications on outcome. A 20-year-old generally, starts out investing, has, what we call a time horizon, 40, 50 years time horizon before they'll consider to retire and use those investments. So they typically can take on a little bit more risk. Someone getting ready to roll into retirement, say in the next 5 years, will generally tend to be more conservative, start to pull back, because they don't want to put what they've already saved to date at any significant amount of risk and delay retiring when they intend to. Withdrawal rate risk. You may think that you've saved quite a bit. Even people that are Multimillionaires, if they're big spenders or having to pull out significant amount each year, generally, general rule of thumb is 4%. So if you've saved $1 million and a safe withdrawal rate of 4%, so it's $40,000 a year. Well, if you're used to being, living on $80,000 a year and 40% is not nearly enough, now you got an 8% withdrawal rate, which means you could spend those dollars of those assets much faster in retirement when you have no one paying you a steady paycheck. So that's what we mean by withdrawal rate. And then inflation risk and deflation risk. So that's the cost of goods. Many of us are experiencing today how the inflation rate went from 2.5% to upwards of 9% in a very short period of time coming out of COVID. And that inflation rate hasn't come down. It's come down, quite a bit, but not to where it was pre-pandemic. So, generally about a 20-year time frame, the cost of goods on average doubles in price. So you might think, hey, I need to save, $1 million in retirement, by the time I'm age 65. But if you need to make it last 20 plus years in retirement, then the cost of goods has doubled during that time frame. Again, that can deplete your assets much faster, on top of everything else to worry about. We remove the emotion from investing. So what I typically see is when I start sitting down with a new, sometimes people come to me who've already built a significant amount of wealth or assets, and they would consider themselves, investors, and they might be just looking for a second opinion. For one reason or another, they've left their advisors behind, or they just did a good job or a bad job doing it on their own. But I'll also have people that'll come to me that are nervous about investing or don't know how to go about it. And a lot of times, too, when the markets are going up and down as they have been doing for a little while now, since 2020, more so than the 12 or 13 years prior, since the Great Recession, is that people don't know exactly when to get out or move, what they call move to cash, sell what they got, and protect the earnings they've earned to that point. Or should they ride it, continue the the investing behavior going forward? And so and again, it comes back to depends. But we'll talk more about that. But what you see on the screen, I'm going to try to blow this up a little bit. And let me minimize this. But we stick to the important principles, and we always advise this way of investing is exercise about long-term financial discipline. So anyone that's considering investing, I often, hey, Jimmy, you tell me the latest stock, or hey, where do you think what's going to happen the next 6 months or a year? And that's not quite frankly what I do. What I more do, or more of my focus is on the behavior of an investor over the long term. If you're looking to get rich quick overnight, in the next 6 months or a year or whatnot, there's not a lot of people out there. Those are day traders. And, if you got money to gamble that way, great. But I'm mainly focused on long-term investing over the long term and diversifying those plans. So long term to me is 5 years or more, staying invested. You don't need the money right away, or you don't suspect you'll need the money right away that you intend to invest. And then you invest it and let it ride over time. And depending on your risk tolerance will help determine, somebody like me, determine what to advise you on, what to invest in and how to invest in. Many people don't have a large nest egg to invest right out the bat. So they typically will invest in things like, if it's an option, a 401k, where they'll systematically pull money out each paycheck. A certain percentage goes into the 401k and it's being invested for them, and just kind of let it ride. And that's okay. That's probably the most successful way or best way of saving in general, is systematically. And that's where you either have an employer or HR is doing it for you, or you try to have create the discipline to do it yourself. But someone like me kind of would advise you on a good savings rate and where to put those dollars and how to set up that system in order to be able to do that. But it's all with long-term financial mindset. If there's something short-term, we can then focus on the short-term, less risk. The long-term, we'll go from there. And so, for example, if you go back to here, and let me pull this up a little bit. What this chart shows is a compound annual rate of return of 10.4% during this time frame. Had you stayed invested and not pulled the money out, not gotten the emotion take over and say, hey, the market has dropped, 20, 30, 40%, I need to get out. Warren Buffett says it best about the best time for investors, the best time to sell is high and the best time to buy is when it's low. So when the markets are actually going down, most of the time people's behavior or emotion is, hey, I need to get out of the market. This makes me nervous and go to cash or protect what I have to this point. And it's probably, if you have a long-term time horizon or long time horizon, that's probably the worst thing you could possibly do. Because you end up, when you get out, you're selling now low, and when you really should be buying. And we never really know when the peak is. I never get phone calls when the market's doing well. But I get phone calls when the market's not doing so well, and hey, Jimmy, what should I do? And I'm like, well, what do you need to do? What's the money for if you get out? If you have a short-term need or whatnot, then that's what it's there for. But otherwise, it's best to just let it ride. I have many, I use 65 as a retirement line in the sand. But most retirees, when they go into retirement, don't pull all their money out at age 65 and live on it from there. They stay invested. They stay fully diversified, and they pull out what they need over time, and then they're hoping that the rest will continue to grow and replenish what they've spent over time. So that, I spent a good bit of my time was about emotion. But this chart here shows back in the 70s, one of the great dips back then was about 40%. So imagine having $1 million, in assets, and now you're down to 600,000, and you're thinking about, just before or just after you were thinking about retiring. So, that's one, major dip during that time frame. Another one was the stock market crash back in the late 80s, early 90s. In that case, it was about 25% dip. You can see another, the dot-com crash was almost 50%. But during 2008, it dropped down, like I said, some portfolios 50, 60%. And then most recently in 2020, I remember going through it where the market on average dropped about 40% in about 6 weeks. It went from peak to bottom and back up in about a 6 to 8 week time frame. And my phone was blowing up. And for those who stayed the course, it was like nothing ever happened. They were thankful they stayed. But there were some that decided that it was just too much, sat on the sideline, and it cost them dearly. They ate that loss. You don't realize gains or losses until you start pulling money out by selling those assets. So it's just it's an emotional roller coaster. And then again, where you might need a financial professional that can kind of keep you honest. I'll pause and see if anybody had any questions up to this point.
Yeah, we do have one question. One of the questions were, what are your thoughts on investing using apps like Robinhood?
It's just another tool where you, as the individual, it's I call it like a platform. It's really no different than, say, like an E-Trade account, Robinhood, and there's probably some others out there. But you are doing it on your own, and I don't have any concerns with Robinhood or platforms like that. I will tell you what was somewhat, in my opinion, refreshing when that app came out is that more and more people paid attention, got educated, played around with penny stocks, Bitcoin, different types of things, and got educated and started learning about, watching how money might grow and compound interest, how they can move things around, buying and selling. people today, thanks to Robinhood and E-Trade and things like that, more and more people are educated about what a stock is, what a bond is, how trading works, risk, and all that. But what at the same time Robinhood has done in many cases is it's gotten people in trouble. People thinking that they could go on there and, hey, I won here, I won there, let me invest more. And so by doing it kind of on your own, there are some risks there if you're not well versed at what you're doing, and you can lean out over your skis and tumble. There's been many reports of people harming themselves when they lost money, because it's about time in the market. It's not about timing the market. And what I mean by that is the people in a lot of times in Robinhood when they're starting out, it's a nuance. They're trying to, short term kind of, that euphoria of winning, and then devastated when they lost. But if you're playing with money that is not a part of your overall retirement strategy, I don't, Robinhood could be a good thing to help educate you in that sense. But, it's not, in my opinion, it's not a platform to manage for retirement. A lot of times people think of retirement, they think of IRA, 401k. Those are accounts that you can invest in, no different than a Robinhood or whatnot. But those are accounts. That's not a retirement strategy. That's one platform where you can buy and sell and invest. But that is not hedging against longevity risk. That's not hedging against health risk. That's not taking into consideration Social Security. So you're not taking into consideration an actual retirement plan. It's just one niche of an overall or asset or bucket of money, if you will, over the long term. But again, we'll come back to it depends. I don't endorse or poo-poo on Robinhood. Did I answer the question? Any other questions?
Yes, you answered it.
Okay, good. All right, so let me get this back down.
Jimmy, I'm sorry, before you
Sure.
go forward, I had another question here.
Mm-hmm.
Is there a difference between using the options that maybe a bank would give you to invest than using like a separate investment firm? Is one better than the other, or does it make a difference?
Again, it depends. So I'm giving my opinion and take it for what it's worth. Banks are set up for checking and savings and doing, mortgage loans and things like that. Banks, like many, even some insurance firms, have over time taken on investments as another line of service. Think of one-stop shop, to where, and I'll use Bank of America as an example, where they partner with Merrill Edge or Merrill Lynch. When you're walking into that bank, however, Merrill Edge is focused on investments, and they are their own entity. They are completely separate of Bank of America, and vice versa. So the bank itself, the teller, for example, is not going to have a license that can tell you what to invest in, the type or whatever, but they may ask you, or someone who's paying attention to how much money you got sitting in your savings account, hey, you probably ought to be considering investing some of that. That's a lot of money to sit there in a savings account and not earn some rate of return on. We could offer you a CD. We can offer you a money market, or if you wanted to do some type of investing, we have, Joe over here at Merrill Edge could gladly sit down with you and talk about that. Better or worse or whatnot, my experience has been is a lot of times they are not trained to provide comprehensive retirement planning. They are accumulating assets. And I don't mean that in a bad way. I'm not poking at them. They're mostly, what they're trying to do is gain assets under management. And the more assets that a bank or an insurance company, more lines of service that they have with anyone, there's less likely of a chance that that person is going to leave and go to another bank. unless they've just had a really bad experience or feel like they've been burned somehow. So the more things they have in place, money market, CDs, checking, savings, mortgage, a home equity line of credit, their investment account, an IRA, whatnot. So what they're doing is in the accounts, but what they offer sometimes, like Merrill, I'll use Merrill again, Merrill might be limited on the type of investments or certain types of mutual funds that they were offering you. They will only offer what they provide themselves. So you could look at that as they're restricted or they're offering, there might be some bias there. Where I'll give you an example, they may not offer you Fidelity and what they have to offer. They might not offer you Transamerica or Vanguard or Brinker or, whatnot. Where a broker outside of that could offer you sky's the limit and all options, from brokerage accounts to advisory accounts, not just IRAs, Roth IRAs, retail accounts, etc. So I wouldn't say they're good or bad or different. It comes down to really about convenience and knowing what you're getting into. And not all banks can offer the same level of service. It depends on the licensing of the someone like me sitting there. They may be able to offer you, for example, mutual funds or brokerage accounts only, but they may not be a license to give you advice. And believe it or not, that's different. Or manage those accounts for you. You think when you have these accounts, 401ks and whatnot, that there's someone managing that, but in a brokerage account, 401ks, IRAs, most of them that I ever see are all, believe it or not, managed by you or the account holder, and that's rarely conveyed. So there's no changes are made unless you yourself request those changes. However, if you're working with someone that can give advice, has the license to give you advice, then they are working for you and advising you accordingly, and you are kind of working together, and you kind of have skin in the game. The advisor is getting makes more money when you make more money, whereas in a brokerage account, it doesn't work that way at all. So again, it goes back to depends. The bank offers one-stop shop options. The bigger banks do offer some investment solutions, but I will tell you that more and more banks these days are getting away from it. You're going to start seeing less and less banks offering investments, and it's the bank itself is not offering the investments. They usually have someone that's dedicated specifically to that, that's going to offer you a niche group of investment options. So it's very exclusive, if you will.
Okay, thank you.
Mm-hmm. All right, so what you see here, I talked about human behavior, and I talked about 2007, 2008. And this is an example where if someone, let me blow this up again to make sure everyone can see it, that if hypothetically you had $100,000 invested in the market at that time, in 2007, you can see where the market value had gone up just before it plummeted about 50%. So imagine having 100,000, maybe it's at 120,000 here at this point, and you're thinking, and you can think it was 100,000, a million, pick your number, but it's going up, and then the value dropped and bottomed out at some point in 2008, early 2009. When I say bottomed out, things started to look back up. If someone had said on the worst day, I'm stressed enough, I've watched my portfolio sink, my 100,000 initial investment now is only worth 50,000. I'm going to take it out, I'm going to set it on the sidelines, and I may or may not get back in the market again, depending on how we're going to sit back and wait and see how things go. And I may get back in it when the time's right. Well, what this chart shows is those who stayed the course, this top line, they ended up experiencing a 13-year bull run. Bull run means year over year on average was a positive return. Longest and greatest bull market time frame in the market's history. And had they gotten out and just sat for 1 year on the sidelines and watched this growth, not knowing this was going to happen, just waited 1 year and got back in, the difference by the end of 2022, that person who started out with the initial 100,000 and stayed the course ended up with a value of about 375,000. Whereas if they just exited and stayed on the sidelines 1 year, only got it back to 243,000. Those who stayed on the sidelines and never got back in ate that loss, that $50,000 loss, and it just, stayed the course from there on out for the next 15 years. So that's where it depends. What do you need your money to do? If you're going to pull it out and set it on the sideline, why? If you don't need it, you're 45 years old and you don't need it for the next 25 years, and that's what you was investing for, was for the long term, for retirement and through retirement. We're talking 20, 30, 40, possibly 50 years running. You would want to leave your money in there. Now, if there's a short-term need, maybe pull some of that money out if you need to put a roof on your house, or, hey, I got to buy a car or whatever. That might make sense. But usually it makes more sense to stay the course. So again, that's where emotion can affect outcomes. This is a chart that shows, if you go all the way back to 1926, when the stock market was created, all the way to the end of last year, this shows about the risk risk in any portfolio diminishes over time. So think of it as kind of like a sound wave, real close. If you bang, a drum here real close, and it's banged right next to you, that reverberation, that vibration can be pretty loud. And, if you were able to measure it, the highs and lows, it would be quite high. But the farther away it goes, the more it kind of tones out and becomes less deafening. And it's kind of the same thing. So if you see here on this, and you went back in time and invested and stayed invested since the 20s, you can see the average rate of return during that whole time frame, almost 100 years, has been an average 10% rate of return when you were invested in 100% stock portfolio. Okay. If you had just a little bit, went 75-25, 75% stocks, 25% bonds. Think of bonds as being less risky and can de-risk your portfolio, which means only 75% is at risk of those reverberations or that volatility in the market. And 25% tends to be the slow and steady, safe money, if you will. And in 75-25 portfolio, still with a 9.2% rate of return. And so you can see over time, what this chart shows is a 12% holding period versus a 5-year holding period. You can see if you held it for 120 months or more, 10-year time frame, even though that might be a 50-50 portfolio, it's still respectable rates of return. When the inflation rate until recently is around 2 or 3%, the whole premise of investing at all, it's not about getting rich quick. It's about staying ahead of inflation. It's investing dollars for a future spending that outpaces inflation. And up until the last couple of years, inflation rate measured was between 2 and 3% on average for that long period of time. Now, what's going on right now is an anomaly, and we don't know if we'll ever get back to that. That's what the Fed today is trying to get us back to. But the whole point of investing in general is delaying spending with dollars that you've earned today and invest in them for future spending, and hoping that it outpaces the cost of goods for a later date. And you can see even the most conservative portfolio still earn, on average during that time frame, almost 5%. Any questions about this information? Okay.
I'm sorry, we do have a question.
Okay.
Hold on one quick second. The question is, where should you begin if you want a long-term investment that is safe and not risky?
All right. So it depends. We're not talking about a time. I didn't hear a time frame, and I haven't heard why. But let's say, for example, and I'm going to talk about that a little bit more in some of these other slides. But today, I'm only talking about today. 2 years ago would have been completely different. 2 years from now could be different again. But today, money sitting in a savings account earning nothing, when you are missing out on an opportunity, probably with the same bank, that where you, if they offer a money market or CDs, you could be earning 4 or 5% rate of return on that right now. And so that would be considered the safest, if you will, investment other than putting money under the mattress. And even that has some risk. The house could burn down. Your friends or family could come and find it and take it. You know, there's risk and everything. But I will tell you the other thing that people don't consider is if you're too conservative, you also run the risk of your money not growing fast enough to keep up with the cost of goods. So if you had money sitting in the bank, for example, and let's say you had 10,000 bucks, $10,000, and you set it in the bank, and I'm going to protect this because things make me nervous right now with the way the world is going right now. I just don't trust it. And I'm not well versed in investing. And you leave that 10,000 in there 10 years from now. In 10 years from now, you look back and you got $10,000 sitting in there and you're feeling good. But what's happened with the cost of goods? Is that $10,000 still worth $10,000? Chances are probably no. So you've actually lost money because you didn't invest it. Now, if you're going to invest in something safe, money markets are pretty safe today. CDs pretty much safe today. But 2 years ago, you would have earned probably on average 0.1% rate of return on that. The only reason they're higher today is because interest rates have gone up. So it just depends. And if interest rates start to drop, which everyone wants to do, those same type of investments are still safe, but you're likely not going to you'll earn a whole lot less on those same dollars. So it depends on what the money is. Now, if I'm looking to, let's say I have $50,000 and I want to buy a house in the next year, and my goal is that I'm hoping that the interest rates will come down, mortgage rates will come down, and I need this money, intend to use it as a down payment to either buy down points or, have a solid down payment to keep my mortgage payments, manageable. That sort of money you don't want to put at risk. That's short-term need. You need it available, but leaving it sitting in cash, you might be missing out on that 4 or 5% you could earn in a money market or a CD. And with little or no risk. So in me, I'm not making a recommendation, but if I was going to park the money somewhere and wanted it safe, I'd want some rate of return on that money today, not necessarily fully invested in the stock market, because you do run the risk of the stock market, that value of that money being less than what you started with at a time when you need it. To answer the question. Any other questions? Okay. All right. So asset allocation over time. So what I'm going to do is bring this back down a little bit so we can see this. So asset allocation, what we're talking about here is important because it can provide you both protection and guaranteed income as well as growth to reach your financial goals. So think of rate of return up at the top. A lot of people want higher rates of return. We want our homes to be worth more than what we bought them for. We want our savings or investments to be worth more than what we bought them for over time. And we want to typically get the highest rate of return we could possibly get. So that's kind of what we're talking about here. But with that comes risk, because the more or the higher performance you expect, puts you at a higher level of risk that it might not go that way. More conservative, less risk, you should not be expecting a higher rate of return. So money sitting in the bank or in a money market should not expect, what someone else might expect being fully invested in stocks, because it's a different level of risk. And that's what you're offsetting or paying for, is that safety, that security. So think about that when you see this chart. And I wish I could get rid of this thing down here. Let's see if I can make this a little. There it goes. Maybe it'll go away. Anyway, so farther to the right, think of more risky, and to the top, higher rates of return to expect. So think of checking and savings being the safest and lowest risk, far left on the bottom. Money market CDs, I just discussed how that might be the next step up and still earn a respectable rate of return, at least today. The next thing, believe it or not, is possibly insurance cash value. Think of whole life, universal life, index universal, anything other than term. Okay, I'm getting, I educate a lot about life insurance and performance and different types routinely with my clients. You know, if you're looking to create a legacy, that's the definition of life insurance, is leaving a legacy to your heirs. And that's the quickest way to do that is with life insurance, or the most affordable way. But that being said, I'm getting more and more people today. I don't know if it's online or what it is, that people are walking in the door day one and asking me about permanent life insurance versus term. Again, it depends, but it is an asset that can offer higher rates of return, not in the market, very safe, very liquid, grows every single day. There's just a lot of benefits to it. But it's not going to grow at the same rate of return as, say, maybe 100% stock portfolio over the long term. It's just a slow and steady, respectable asset that has many benefits tied to it. And then as you continue to go up and higher, with higher expectations of a rate of return and risk, now we're talking about possibly fixed income bonds. So think of bonds. You own the debt if you own a bond of a particular company or a municipality. You know, in a municipal, it could be a school, it could be any number of things. But what it is where, just real quick on the bond, is if I'm trying to raise money for one reason or another, maybe it's to build another facility, maybe it's so that I can expand or upgrade my equipment or whatnot. I have an option where I could, you know, if I'm looking to go public, I could set it up to where I offer stock and offer that to the public. And the more people that buy that stock, and the better my company performs, the value of that stock could be going up over time. But what I'm looking for there is investors in my company. If I don't want investors in my company, and I'm just looking to raise cash, and I could go to the bank and say, hey, I need a couple $1 million to expand. The bank might suggest, rather than coming out of pocket with it, that I offer a bond, or they set up and facilitate offering bonds. Now, someone like you or I could then buy that bond at a premium or at a discount. But typically, a bond, you're buying pieces of that debt that has an average rate of return, just like it would, say, any other debt, maybe 6, 7, 8% today, that you're getting consistently income from that investment. And so that's what they mean by fixed income until that bond matures. That you could buy a 10-year bond, 20-year bond, 30-year bond, whatever the case may be, and you're earning interest just because you hold that debt until that debt's paid off. And once that debt's paid off, you're no longer earning interest on it. But that's considered pretty safe as well. Also, if that company had gone out of business for one reason, they went bankrupt, and through bankruptcy, the first people that's going to get paid first are all debtors. So any debts on the books, including bondholders, they get paid first. If you own stock in that company and that company goes bankrupt, you are the last one that gets paid. Everyone else gets paid before you. And then if there's anything left over, it goes to the shareholders. So that's why the level of risk goes up over time when it comes to stocks to the right. But there's an expectation that hopefully you're getting a higher rate of return with that risk. So as you move on up, there's investment grade bonds, high yield bonds. Then you start moving over to what they call equities or stocks. And there's domestic, that's all the stocks that are offered in companies in the United States. And then there's international everywhere. Large cap, think of companies that have $10 billion in cash or assets on their balance sheet. Think of your Amazons, your Microsofts, Teslas, and so on and so forth. That could, think of when your economy goes into a recession, there's a pretty good chance some companies are going to fold because they don't have enough money on the balance sheet to sustain, or depending on what the business is in, people are not buying their goods during recessions, and they could fold. So the more money you got on your balance sheet, typically you can ride those out. So people that invest in large cap are expecting a dividend. That's another way you can earn money and have that money compound on your investment is through a dividend that's only earned off of stocks. Where bonds, you're earning interest; on stocks, you're earning dividends. But more risky would be considered a mid cap. Those are companies that have 2 billion to up to 10 billion. Small caps are those companies that have less than 2 billion on their balance sheet. And small cap would be considered a riskier investment than a large cap, and likely not earning dividends at all, because what money is earned from that company through stocks and values is being reinvested back in the company before they get to a point to where they can then pass on any retained earnings to their shareholders through dividends. And then think of international as being more risky than investing in domestic stocks as well. So there's a level, if you think about it, if you're building a portfolio of 50-50, for example, you could, think of general age of 50-year-old. They're closer to retirement than they are when they first entered the workforce. So as you move closer to retirement years, you typically see less in equities and more in protection/investment or bonds, more conservative investments. Someone just starting out in their 20s might have an 80-20 portfolio, where 80% is in stocks and 20% is in investments. So the reason for that is because of the time horizon. You want your assets to grow and outpace inflation. Whereas if you might be some of these lesser risk type of investments, they may keep up with inflation or just break even, slightly below, slightly high. But you're not, if you stay consistently here throughout, you're likely not going to build the sort of wealth that you had hoped over that time frame. Okay. Again, another eye chart, but what this demonstrates is, stocks, bonds, government bonds being less risky or more safe than municipal bonds, treasury bills being even safer. But you can see in these lines, those who might have invested or put their money in the stock market back in the 20s and held it to date, you can see stocks has well outpaced everything else. Where municipal bonds, if you go all the way back to the 20s, it's just slightly over what you in a 100-year time frame. It's barely worth what you started out with 100 years ago. If you go down to treasury bills, believe it or not, treasuries over that same time frame. And someone just asked me about what to invest in for conservative. Again, it depends. If you just need that money to earn a respectable rate of return for a short period of time, great. But look over this time frame, you would have actually lost money. So it depends. Safe is not always best, and risky is not always best. Okay, before I get into this chart, any questions? I'll pause real quick. Oh, wow. Time flown by. I'm going to have to, we'll have to go because we timed for an hour and I've got more people, but I'm going to go real quick and with this. What this basically says or shows is small stocks. I talked to you if you were in equity, small stocks kind of more risky. You can see how from time to time, this top row, they were the best place to have all your money. But there are other times where that year might have been best if you'd invested all in an international stock. So there might have been times where you would have been best in treasury bills that year. So in 2022, actually, best place to have your money would have been in Treasury bills, earning a whopping 1.4%. And you can't go off of what happened the year prior. So the bottom line is having a portfolio that is diversified, that's built with a smattering of all this. Okay, and so it just depends. So you can see in the middle, a fully diversified portfolio, you never hit the high, but you never hit rock bottom either. And so a fully diversified portfolio, you can see, earns respectable rate of returns over time without taking on too much risk or being too conservative. Some of this is a little bit of an eye chart or more what we talked about. I want to caution many folks that might have a 401k, for example, and I'm not poo-pooing on 401ks, but it's everyone's familiar. Most people are familiar with a 401k. Usually gives you some mutual fund options to invest in. Some people will purchase multiple mutual funds. It could be from American Funds, Fidelity, whatnot, thinking they're diversified. But oftentimes when you peel back and do a deep dive into each one of those funds, many of those funds are invested in the exact same things, just at a different percentage. So one fund might have 10% Microsoft in it. The next fund that they've also invested in might have 7% invested in Microsoft and more weighted somewhere else. So you can see on the left, they're not as diversified as they might think when they have multiple mutual funds that they've invested in. And by breaking that up or working with someone, a financial professional, they can separate and break that up and have you invested and truly diversify your portfolio without any significant overlap. I'm going to move on. There's a chart I want to show everyone, this one. You can see here over a time frame from 2003 to 2022, so a 20-year time frame. Most recent 20 years. Annualized rate of returns, anyone in a stock portfolio, average rate of return 9.8%. Average investor managing their own portfolios was earning 3.1%. So someone asked me about Robinhood. That's pretty much doing it on your own. E-Trade, whatnot, dabbling in your just, hey, I don't want to pay nobody, I don't trust nobody, I'm going to do it myself. I'm the professional, most are not. So the average rate of return for the average investor doing it themselves about 3%. So you're losing 60+% average rate of return. And when it comes to compounding, that is a significant amount of money or wealth unrealized. You can see in a completely 100% bond conservative portfolio at 2.6, barely keeping up with inflation. And here 2.52, this was as of last year. But this is about the average over the long term for inflation. So you'd want to learn at least that much, and that's breaking even. If you're earning less, guessing wrong, then you'd have been better off leaving the money in the bank and not earning anything. Even in a 50-50 portfolio, 50% stocks, 50% bonds, which is pretty conservative or middle of the road, I would say moderately conservative, earns a 6.5% rate of return. Here, I want to demonstrate this. If you were invested in that 20-year time frame, there was a total of 5,000 trading days. If you were invested in all of those days, your average rate of return 9.8%. But if you missed the 10 best days, you were sitting on the sidelines, had your money not invested, your average rate of return could have been would have almost cut in half. If you missed the 20 best days, missed the day that one day it jumps up 10%, another day it jumped up 8%, the next day it might have whatever. If you were not in the market on those 20 best days out of that 20-year time frame, that's 20 days out of a 20-year time frame, your rate of return is less than the rate of inflation it is today. And if you miss the 50 best days, you are in a negative rate of return. So the point here is that you need to stay invested and don't let the emotions take over. It's about the long road. And so that's pretty much it. You can see here about working with, and it says Park Avenue Securities, but any trusted financial advisor that's out there, and that could be tough to find. I'd ask around, who do you trust and whatnot. If you're looking for a financial strategy, you'd want to work with a financial professional that offers more than just managing an account. They're talking to you about cash flow. They're talking to you about life insurance, wills, trust. They're talking to you about how to fund college. They're talking about investing in different things when it comes to tax implications. There's different types of accounts. So investing in a 401k or an IRA is not a retirement strategy. It's just an account. So you want to avoid common risk while focusing on both protection and growth. Remove the emotion from investing and have a long-term plan. Even if you're getting ready to retire tomorrow, you should still have a long-term plan, because the average retirement is 20 years or more. Create a personalized strategy that reaches your specific goals and what you're trying to achieve. And they should be willing to educate you on everything that goes with that, risk and whatnot. Discuss your strategy over time. You need to have continual reviews, meeting with that advisor or seeing how things are going over time, and understanding those risks. As you get closer to retirement, of course, you want to try to be more conservative in most cases. If someone has not helped you or talked to you in 20 years, you could be too much risk and need some adjustments, and you may or may not know how to do that. Focus on appropriate asset allocation. It's not about rate of return. And oftentimes it's where is that money parked, and being diversified. Create a diversified portfolio with focus on overlap or lack of overlap, and then reinvest those earnings where possible to take advantage of compound interest. Any questions at this time? I cannot believe how fast that hour went. We good?
All right.
Awesome.
All right. So that was wonderful information. Thank you so much, Jimmy, for that presentation. You said a lot in there, and I think it's going to really help us as we move forward in seeking investment opportunities. I understand that some of you may have questions that are specific to your situation. Please reach out to Jimmy. You see his information there on the screen. Give him a call, send him an email, whatever you need to do. If you have more detailed questions or you want to use his services, definitely reach out to him so that he can help you with the answers that you need. You can also email the Legacy Program at legacyprogram227@gmail.com if you have any questions for us. And follow us on Facebook at My Legacy Program. We put a lot of our classes that we're going to have in the future. We post them there. We post the opportunity to register. So definitely follow us on Facebook. We also have a YouTube page, which is My Legacy Program. That's all together. So go ahead and subscribe to us on YouTube also. And we have a lot of our past videos on YouTube as well. Again, Jimmy, thank you so much for your time. We are honored that you were here with us today. That was fantastic information, and it really gives us a lot to think about as we're moving forward in investing. And I want to thank each and every one of you for taking the time to join us today. Look out for our next class and have a great weekend. Thank you so much. Bye-bye.